In this module, we're going to look at accounts receivable and what we do when we realize that some of those accounts receivable may not be collected. We'll also take a look at how we handle credit card sales and how do we reconcile the amount that we show as our accounts receivable with the amounts due from the individual customers. So just as a reminder, this is how our accounts receivable works. Accounts receivable are amounts due from other companies that we have sold to, and a sale on credit looks like this. We debited the accounts receivable, we credited sales, and then remember every time we have a sale, we have the debit to cost of sales and the credit to merchandise inventory. That entry was omitted in this example. And then when we collect the accounts receivable, we debit cash and credit accounts receivable. If we take a look at our general ledger then, here are the debits going into the accounts receivable, and we come up with our running balance. As they pay, we credit and reduce the accounts receivable balance. And then over here we have our accounts receivable ledger, which is the individual customers. So in this case, we've got Comp Store. Comp Store had a credit sale on July 1st of $950. So we see that coming in as a debit to Comp Store's amount because they're the customer accounts receivable, and we add that to the running balance. On July 1st, we also received a payment from RDA Electronics, so we post that to, this is called the subsidiary ledger for the accounts receivable. We post that to the customer's subsidiary ledger account as a credit for $720 to give us a remaining balance of $280. At the end of the month, and usually the end of the month, we will do a schedule of accounts receivable where we go into the subsidiary ledger, we add up all of those accounts, bring their balances over, and make sure that this total on our schedule of accounts receivable, here it's $3,230, equals the balance showing in our general ledger account. Let's talk about sales on store credit card. Here you can see that we have the sale coming through and we record it as an accounts receivable because we'll receive the money from the credit card company. So accounts receivable is debited for $1,000 and we credit sales, and we have a 1.5% per month interest on seller credit card. So on December 31st, we recognize that interest revenue on the balance that has not been paid. We also might have a credit card transaction with a bank credit card. How the bank makes money is they charge the retailer or the seller, the person who is accepting the credit card, a fee. So in this case, we had a $100 sale and the credit card company charges us a 4% fee. So we're going to debit cash for $96, debit the credit card expense for $4, and credit sales for $100. Amounts owed by customers from credit sales for which payment is required, sometimes we can extend that payment time. If we do that, we usually will charge a percent of interest. At this time, I ask you to open up your workbook for lesson 1, and we'll walk through the problems. We'll be working on exercise 7.1 first on page 292. In exercise 7.1, we're given the transactions that were recorded during the month of November by Vail Company. We are to post those to our general ledger accounts. Those are the ones highlighted in yellow: accounts receivable, sales, sales returns and allowances, and to the subsidiary accounts, the individual customer accounts: Ski Shop, Welcome Enterprises, and Zia Natera. So let's start with the first one. On November 5th, we debit the accounts receivable for $46.15, and we know that's to the ski shop, so we're just going to come down here and do the same thing at the ski shop. Debit that for $46.15 as well. Our credit goes to sales for $46.15, and we have the first one done. Next, we have accounts receivable, Welcome Enterprises. That is a debit on November 10th for $13.50. We go to Welcome Enterprises on November 10th and put in a debit for $13.50. And then we have to remember to go to sales and put in our credit for $13.50. Next, on the 13th, we have a sale to Zia Natera. We will record that in accounts receivable in the customer's account and in our sales account. Remember, left side of the T account is the debit, right side is the credit. On November 21st, Zia Natera returned some goods, so we will record that. On 11/21, we have a return of goods of $209. We know that that decreases accounts receivable, so we'll come over here and do a credit for $209. And now we have to remember to do the same thing on the customer's account. So 11/21, credit for $209. On the 30th, we have another sale to the ski shop for $27.13. And a sale over here for $27.13. And we need to remember to post it to the ski shop, $27.13. Let's go ahead and get our balance. So the balance in accounts receivable will be equal the sum of the debits minus the sum of the credits. So we have a balance for accounts receivable of $93.01. We have no debits in sales, so we can just sum that one. That will be a credit balance. Same thing over here in the returns. I'm just going to copy from the accounts receivable. So we have accounts receivable debit $93.01, sales credit $95.10, and sales returns and allowances $209. And if you do some quick mental math, you can see that our debits are equal to our credits. Now we're going to go down to our subsidiary ledger and sum up these accounts. And I'm just going to copy that over to Welcome. On Zia Natera, we need to make sure that we get the credit. So we've got the debit over there minus the credit. So our balance for Zia Natera is $623. At the end of the month, we do the schedule of accounts receivable. And what we're doing here is proving that the balances in these subsidiary ledger accounts equal the balance that we show in our general ledger account of $93.01. So in our ski shop, our balance is $73.28. Our Welcome Enterprises, $13.50. And Zia Natera, $623. We'll total that up. And we get $93.01, which is in balance with our accounts receivable. If it weren't, we would have to go back into our accounts and search for errors. Next, we're moving on to exercise 7.2, which is also on page 292. In this exercise, we will be looking at how to record credit card transactions. And we will see that we sold merchandise and accepted the customer's bank cards, so we are being charged a fee in both instances. Now, the turnaround time on the credit card transactions is pretty quick, so most of the time we just debit cash for the sale. So on April 8th, we know we're going to have a debit to cash because we had a sale. We will also have a debit to the credit card expense. That's what we use to record the fee that is charged by the credit card company. And we know that this is also a sale, so we will do sales. Well, the sales is the easy part. That's 4,200. And the credit card expense is 4% of that. So we'll take the 4,200 times 0.04. So the cash we receive is the 4,200 minus the credit card expense of 168. Remember, we also have to record our cost of goods sold, and we're told that that amount is 3,100, and we remove that from our merchandise inventory. Notice I haven't been recording the descriptions, and you don't have to do that either. We need to remember that we do need to do that when we are recording them, but as we're learning, we're going to omit them for now. On April 12th, we sold merchandise again, accepting a credit card with a 2% fee, so we know that we'll have the same, right? We'll have cash, credit card expense, and sales. I'm just going to copy those down. My sales number is 2,000. My credit card expense is the 2,000 times 0.025, and my cash is the difference between those two numbers. We also know that we need to record the cost of those goods sold, and that number is 1,500. We remove them from inventory by crediting merchandise inventory. In exercise 7.3, we will record the transactions for a store credit card. So this is the store's own credit card. They're not being charged a fee by the bank. Here we have Zmart selling merchandise for $1,000, and they accepted their own card. So we're going to say accounts receivable from the customer here for 1,000, and we'll record sales for the same amount, 1,000. Again, we have to remember to record the cost of goods sold, and that amount is 650. And we take that out of our inventory account. On the 31st of May, we record the interest earned on our credit card. So now we increase the accounts receivable because we haven't received it yet. We will receive it when they pay it, $4, and our credit here is to an account called interest revenue. And that is the end of lesson 1.